The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box. I'm Steve Sedgwick with Carolyn Roth, and these are your headlines. Well, I don't know what you lot expected out there, but obviously not what the Fed delivered, because the dollar spiked, treasury yields climbed, US equities sinked. This all after the Fed Chair Powell delivered a more hawkish cut than some of you had been expecting, signalling less easing in 2025 and beyond.
Our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate.
Well, those fears over fewer rate cuts are compounded as the president-elect, Mr. Trump, threatens to scupper a bipartisan funding bill, pushing the US government closer to some form of shutdown.
Asian equities follow their Wall Street peers into the red, while the BOJ keeps rates on hold as expected. Economists expect a hold from the Bank of England as well as borrowing costs hit a 3-decade premium against Germany amid higher inflation and weaker employment data. Follow live on Decision Time later on today.
I don't understand everything in these markets, and God knows I try to understand as much as possible, but what happened yesterday? Did I miss something? Did the Fed do something that was completely out of kilter? Did they say something about the level of rates at the moment that I missed? He said four times that we're in restrictive territory. He said he still thinks we're on a path to 2%. He said we're still cognizant about the labour market implications. And we all knew going into this that the CPI was stronger, the retail sales were strong, that the jobs market remains intact, that the growth figures look pretty good, and that we've got some concerns about the level of debt that's going to be taken on, ergo that might affect the rate cutting ability of the Fed going forward. What bit did I miss that meant that the markets plummeted yesterday? Seriously, what bit? I'll ask Naomi Prince, she'll know. The Fed delivered a widely anticipated, no one cared about this bit there, did they? The widely anticipated 25 basis point cut at the meeting yesterday. But Jerome Powell described the decision as a closer call than in recent meetings. Cleveland Fed President Beth Hammack was the sole dissenter, but the closely watched dot plot, this is where we all knew this, we talked about it for weeks, it's all about the dot plot, suggested that three others did not want to cut rates. Policymakers indicated the Fed would cut just 2 more times through the whole of next year, with only 5 of the 19 officials projecting more than 2 cuts. And here's the point, everyone. They're looking at the same data we are. They don't know for a fact it's going to be 2, 3 or 4. We've seen how many times the Federal Reserve have got it wrong, haven't we? Jerome Powell repeatedly stressed the need for caution.
We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market, while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate.
The Fed also released updated economic projections. This is the point, isn't it? Raising its forecast for headline and core inflation in 2025, as well as upgrading the growth outlook. That's a good thing, by the way, if you upgrade the growth outlook. For all of you who sometimes worry about that, or sometimes worry about whether enough jobs are being created or enough jobs lost, you oscillate, don't you? Let's be brutally honest. Anyway, they upgrade the growth outlook and forecast lower unemployment. That's a good thing as well, for those of you who are bearish. Lower unemployment than seen at its last meeting. Carolyn, I might have a look at the old tapes of this show, because I'm sure we discussed all this for weeks.
Yes, absolutely. We were expecting a hawkish cut, but what the markets got obviously was a super hawkish cut. And this is how that hawkish view ripped through asset markets. I want to show you the equity markets first. The Dow off by 2.6%. This is the 10th day in a row that the Dow is declining. The S&P off by 3%, the worst performance since August. And the NASDAQ comp off by a whopping 3.6%, its worst performance since back in July. And obviously we also saw that sell-off in the treasuries, a spike in yields, and we're looking at yields that are trading close to 6-month highs. The 2-year yield 4.3%, the 10-year treasury yield well above that 4.5% handle, 4.52%. And the big question, Steve, for the markets going forward is to what extent will these higher yields be a problem to equities? I want to show you the dollar very quickly because the dollar pair, or the dollar index rather, at a 2-year high. Euro dollar currently changing hands at 103.80. Sterling dollar in focus today as we're expecting that BOE decision. No change there expected, 125.85. And dollar yen after the BOJ was pat at 155.28. Remains to be seen whether the Ministry of Finance will become active when it comes to currency market interventions or job owning the currency higher. Asian markets look like this. We're seeing the Nikkei 2 to 5 under a great deal of pressure, down by 0.2% on the back of the BOJ decision. The Hang Seng off by 0.8, and the Shanghai also trending somewhat lower. Was it an overreaction? Probably to some extent.
I don't know. Nomi Prince joins us, founder of Princesight Global. You're still on Fed Reaction Day. We're on the day after, Nomi. It's about 5:10 where you are in lovely California. Nomi, what have I missed? I'm really thick at this. I think I'm getting worse at this job, if that's possible. Because I'm kind of nonplussed. We knew this, didn't we?
We absolutely knew this. I think it's an overreaction. It's similar to the overreaction that we had sort of about 6 months ago when the Fed was almost going to cut and then didn't, and then almost was and then didn't, and there was going to be data dependent and then didn't do anything. And the markets were really sort of volatile around that period as well. I think what happened was obviously everyone knew, widely expected, widely anticipated, as you quoted, that this was going to be a 25 basis point cut. It doesn't actually mean that the entire cut for this year is miles away from what it was when they cut the last 25 basis points. We're from 75 basis point cut to 100. Globally, we're at about a 650 basis point cut for the major central banks. We have pivoted to lower rates. The fact that Powell, who is never very warm and fuzzy about what he's going to do in terms of accommodative policy anyway, was less warm and fuzzy about the potential than he has been in the past, is that I think got markets really upset. I think it's very reactive to stuff we already knew. But one thing also, which was interesting, is more like a lack of confidence in the Fed that markets basically noted, which is that growth figure. The reality is a lot of growth estimates for the United States have been lowered as we've gotten to the end of this year. The job market is still where it is. Went up from 4.1% unemployment to 4.2% last read. Obviously, we're higher in inflation year over year, 2.7% CPI than Powell and the rest of the Fed might have liked to have seen by the end of this year in their inflation battle. But the growth itself is actually slowing. The Conference Board has it at 1.7% for the U.S. next year. It's slower around the world. So I think what's going to happen, and this is why this is an overreaction, is that sometime next year, a few FOMC meetings in, these real numbers about economic growth are going to come home to roost. They're going to look slower, just like labor ultimately did and the Fed to cut from September on to now. And I think we will see more than 50 basis point cut that's currently dot plotted right now.
Nomi, very briefly here, because you mentioned it before, in August we saw this outsized reaction to the market on the basis of what the Fed told us. We were wrong-footed by the Fed twice now this year. Does the Fed need to do a better job in terms of communicating?
I think the Fed needs to do a better job at looking at the actual data that they're communicating, that they're looking at, because they're not listening actually when they're communicating to what the market, to what analysts, to what we're saying about the data that is the same data they're seeing, which is slightly slower growth, which is slightly worse unemployment figures and so forth. So when the messaging comes that's the communication isn't as direct, but also it seems like the numbers that they're looking at and the numbers that we're looking at aren't being communicated sort of properly or accurately. I think that's an issue. We are looking at growth figures that are slowing down. That was not mentioned. In fact, the Fed actually raised its growth projections. Yes, it raised its inflation projections, and I think as a way to save face, also raises growth projections as if we're not doing as well fighting inflation. So let's just say growth is high as well. But the reality is we're seeing numbers outside of that say something very different. So I think it's two things. It's actually reading accurately and communicating more effectively.
Naomi, I'm a great participant in the game of giving leading questions. I should have been a barrister. So here's the leading question number one. Who suffers most from higher rates for longer? Is it A, a consumer, which actually has a decent household balance sheet at the moment? Is it B, a corporate sector, which actually also has a fairly decent corporate balance sheet? Or actually is it the government that has an unproven business model going forward that's going to keep deficits at over 6% going forward?
First of all, it's definitely the government. The government is looking at, and we've got a debt ceiling conversation happening in the beginning of the year, January 2nd, 2025, where the debt ceiling is going to be debated in Congress because it was 31.4 trillion. It had been abandoned, and now it's coming home to roost, and we're currently 36 trillion, sorry, not billion, 31.4 trillion to now 36 trillion. So that's an issue, and that's going to be more expensive debt because the higher for longer, even with that 100 basis point cut, that 100 basis point cut's really only affecting the front end of the curve, as we've seen the long end trading off, the curve steepening. So the expense of the government carrying this debt forward and in increasing its debt load at these higher for longer levels actually impacts the government, which actually creates volatility in terms of government policy and even following some of what Trump has said he wants to do. And I think that's going to create general sort of uncertainty in the overall environment politically. The consumer is hurt by it also because it's not like banks are sort of offering these massively low rates or lower longer end or longer term loans. They're not. Consumers are still paying record high comparatively interest on credit cards, on car loans, on home loans, and et cetera. So I think it really hurts everyone, but it hurts the government more.
No, we've heard repeatedly on the show that the bond vigilantes, they're just waiting around the corner. They're due for a comeback. Really? Are investors really, when it comes to the U.S., will they be demanding higher risk premium on the long end of the curve?
Well, they are to an extent. And I think this is where that uncertainty comes in, because if we start to also see tariffs and we start to see our deficit rising, we're going to start to see more fights about the debt ceiling. All of that's going to create more uncertainty at the long end of the curve. So that's what we're going to see. We'll still see investors, as we have, pile into the U.S. stock market relative to other markets because of other factors. But in terms of the long end of the bond market, I think that's a harder sell. We only have to look at the People's Bank of China as just one example of one of the largest, or had been the largest U.S. Treasury holder in terms of reserve for years, and now has basically cut over the last few years its $1.3 trillion stash U.S. bonds to $750 billion. Now, there are geopolitical reasons for that as well. But on the face, they have cut their willingness to lend to the United States. I think that's something, and one of the major reasons that the U.S. market continues, bond market continues to steepen.
One more for me, Naomi, before we let you go and enjoy the rest of your lovely Californian evening. It's quite cold over here, by the way. In terms of the market reaction yesterday, if the market was just reacting to what they heard from the Fed yesterday, I think we're on the same page. We think it's a bit of an overreaction. But if the market's also reacting, if it was just the touch paper to a whole load of other concerns about, as you mentioned there, the potentially shutting down of the federal government as well, about valuations themselves, about some of the tech stocks maybe having gone too far, about a lot of other issues that may or may not happen under a Trump presidency, then maybe it's more logical as well. How would you say, in terms of valuations, we are compared to how many risks there are out there at the moment?
I think all those risks are valid. I think that's one of the reasons we're going to see a bit of jaggedness in the markets as the year opens. I think there's a lot of uncertainty as to what tariffs will be slapped onto or added to the current tariffs in the United States when Trump comes into the office, how by executive order or other methods, what that's going to do in terms of tariff wars, that's going to do to overall supply chains, to inflation increasing, and that uncertainty coming back again into the long end of bond curves. So I think all of that is valid, and all of that will hang on the market. In addition, in general. How will this government, how will the Trump 2.0 government actually act? We've already seen a walk back of the current budget from a Republican acceptance to now a Republican non-acceptance because of something that President Trump and Elon Musk had said today. So the fact that we're going to see a lot of volatility around policy, around tariffs, around inflation that could be caused by these tariffs is going to weigh on the markets. At the same time, I think it's also going to weigh on growth, and that's going to potentially move the Federal Reserve to reducing rates by more than they say they will. I think this is all going to play out over several months in the beginning of the year, and we will see more volatility come in as a result.
Yeah, and goodness knows the Fed's been blindsided by data once or twice, hasn't it, with transient inflation. We won't go back to that one, though. Naomi, you're one of the guests who really make this show in 2024. So thank you so much indeed for all your contributions. And I cannot wait for 2025 to speak to you lots more. You're a terrific guest and you've always got brilliant things to say. So thank you very much indeed. And we'll see you next year. Naomi Prince, who is the founder of Princite Global, joining us out of lovely and warm California, as opposed to dank and damp London at the moment. It's just damp. Where's all those lovely crisp mornings? Anyway, for more on the Fed's decision and what's changed in this month's statement, head to CNBC.com. Carolyn has moved to the wall.
And still coming up on the show, the Bank of Japan keeps its benchmark rate unchanged. We'll bring you all the details next. Plus, more on the central bank front. Investors expect the Bank of England to keep rates steady at today's meeting as UK inflation jumps. And we'll get a health check on the live events markets later this hour with Viagogo's head of business development. Stay tuned for that. Very busy on the central bank front. The Bank of Japan has kept rates on hold at 0.25% in an 8-to-1 split, with one hawkish member voting for a 25 basis point hike. Lin joins us with all the details from Hong Kong. Now, Lin, some economists argue that this would have been the perfect window for the BOJ to hike given the hawkish Fed, but they didn't.
Yeah, indeed, Carolyn. That is the view that we did get from some of the economists that we did talk to as well, that, the economy is tracking in line with projections, so why not move this month? Now, we will get more details as to the why from Kazuo Ueda when he gives his press conference in a little while from now, but certainly what economists are saying is that perhaps they want to see more in terms of the wage momentum next year, particularly for small and medium companies that employ the bulk of the Japanese people, or they might want to wait and see what comes from a Donald Trump administration. Perhaps on day one, we could get him announcing a bunch of executive orders, noting his inauguration happens a few days before the January monetary policy meeting as well. But as far as this decision, as you had highlighted as well, that this was as expected, so the response in the markets are pretty muted. We did get the statement, and a lot of it was a reiteration of last month in terms of the economy recovering moderately, as well as consumption, and noting the high degree of uncertainty ahead for the Japanese economy. So as I said, we would be waiting for those signals from Ueda, but I do also want to point out two key things here. The first is that this meeting, unlike the last one, we did get a dissenter, Tamura-san, a known hawk on the board. He believed that the Bank of Japan should raise rates by 25 basis points because he said that the data was tracking in line with projections. He said that he was worried that prices could be skewed to the upside, so perhaps inflation overshoot. So you wonder if that could translate into some hawkish signals coming from Ueda. And the other thing, of course, is the currency, because we have crossed 155 now. In the last 3 months or so, depreciation depreciation of the yen by about 9%. Then you add on to that the Fed, particularly the outlook, the likelihood that we're going to get less rate cuts coming up in 2025. So that could mean that could prompt the BOJ to have to move more because of concerns around yen depreciation, with those interest differentials that's still very wide as well. And a major concern, of course, in terms of imported inflation for Japanese households and also for the Japanese government, guys.
Lynn, I want to pick you up on that point on the currency depreciation. 155.12 is the level that we're currently trading at in terms of dollar yen. At what point do Japanese officials become nervous again and maybe start thinking about intervention or jawboning the currency higher?
Yeah, Carolyn, I mean, we've spoken to economists about this. Some say 155 was a very, very key level. But also, of course, we did get to 162 earlier in the year before we did get that intervention. We are certainly watching out for perhaps some of those verbal interventions, some warnings to come through. But, you know, as well as the level, we know that policymakers are also worried about the pace of that change. We have seen that the depreciation hasn't been moving in an extremely volatile manner, a la what we saw in early August when we had the yen carry trade unwind. So that's one thing to note. But certainly, as dollar yen creeps closer to that 160 level, this is a major, major headache for policymakers because of, as I said, imported inflation. Let's not forget Japan imports most of its energy and a lot of its food, and that has a major weight and a concern for households as well.
Super duper. Thank you very much indeed for that superb report there. Lynn, thank you. Right. The Bank of England is expected to hold rates steady today after November saw the country record the highest rate of inflation in the G7, exceeding the bank's own projection at 2.6% this year. Also weighing on policymakers' evidence is that wages rose more than 5% on average in the 3 months to October, way above the 3% rate most MPC members would see consistent as with their 2% inflation target. Meanwhile, we spent a lot of time looking at the spreads of OATs over bonds. What about the gilts? This is an interesting pair. Worries over the S word. No, not me. Stagflation. Stagflation have sent UK borrowing costs to their highest premium over German debt since the country's reunification in 1990. That's German reunification, by the way. The 10-year gilt yield is now comfortably above the 4.5% mark, up more than 30 basis points over the past 2 weeks alone. Well, as I've mentioned in previous shows as well, the barbell of having gilts in your portfolio as a protection has been absolutely rubbish. Let's be brutally honest about it. It's not been a great trade, despite all those people out there telling us how gilts at 4.5%, just fantastic value. So it's not been great value. So what's the difference between the United States and our conversation about hawkishness there and our conversation about hawkishness in the United Kingdom? Well, many differences, but one of them is you've got a stock market that believes that actually there is growth in the individual corporates, and two, there is a set of data that comes out on a regular basis that says actually the underlying growth is strong in the United States. We're talking about kind of 3% growth levels as well, which is wiping the floor with most of those aforementioned G7 countries. The UK just had the most damp squib, potentially recessionary quarterly GDP data. I think off the top of my head it was negative 0.1% as well. So the stagflation concern is alive and very real when you've got the wage figures considerably above 5%, you've got the growth non-existent as well. No wonder people are beginning to worry about what happens next in the United Kingdom and how the MPC, despite Swati Dhingra, who is there as the key dove, despite her as always the one who's going for the most cuts as well, there are real concerns that the Bank of England is going to be impotent in this, and actually the government, which can make measures, has actually made things worse by being so fiscally punitive on British corporates.
And the government really has boxed itself into a corner. The Chancellor, Rachel Reeves, in terms of the budget she delivered, on the back of that, we saw yields spiking to a 1-month high. Again, as we discussed, not quite the Truss moment, but what if yields go back above the levels that we saw after Truss? At that point, it becomes very difficult for the government, for Rachel Reeves, to stick to her campaign, to her government promises that she made during the budget announcement.
I don't know how they change it. I don't don't know how they...
Exactly. So they'd have to hike taxes or they'd have to cut spending, but that would be a major break. Do you really want to do that a couple months into the new government? And that very much raises concerns about debt sustainability. So are the bond vigilantes that we talk about when we talk about the U.S., will they come for UK debt?
I think I understand your concern. I don't think we're anywhere near a trust moment. That was basically unfunded tax cuts that, quite frankly, ignored the bond market, ignored the city, ignored what everybody's saying.
But are we going in that direction?
Well, we may be going in higher yields on the gilts, but I don't think it's because you've got a fiscally irresponsible budget. Look, I don't particularly like paying higher taxes. I don't think it was good for the country the way they did it with the NIC contributions increasing and coming in at a lower level.
Look what it's doing to hiring. It is atrocious.
I agree.
There is no certainty when it comes to the employers. No one's hiring at this point in time. There's weak growth.
Well, that's not actually entirely true, because actually there is a problem for many sectors finding the right people, actually. And if there's any problem, as we saw from the wage figures most recently, is actually in the right sectors there is huge demand, and ergo why we have that wage price inflation as well. So actually, there are certain sectors. I was listening to a software engineer talking on the phone yesterday on a talking program. This is how it's become central. It was a talking program that normally talks about other issues. It was talking about the fact, because of the desire to bring down legal and illegal immigration, and because of maybe entitlement in UK employees, I don't know if that's true or not. Personally, I'm not sure it's true. That actually there were real problems hiring. So there are certain sectors. The other case for the defence for the government, and I'm not here to defend the government by any way, shape or means, is that they have enormous growth plans which require public sector money. Once that kicks in, that is going to basically mean there's a lot more jobs needed, for instance, in construction, and in infrastructure projects as well. So I agree. The atmosphere at the moment feels toxic. It feels very difficult. But the case for the defence, and people like Callum Pickering have been making this point to me off camera the other day actually as well, once the government spending kicks in, there is a lot of job creation going to go on in certain areas.
And the key question here, I would add, is the market patient enough for that growth to kick in and for that growth dividend to materialise?
And will that actually benefit a lot of FTSE 100? Well, you say bond market. Okay, that's the clarity, yeah. Because a lot of the equity markets are those companies which are little retailers, a lot of banks, a lot of materials companies. Are they going to benefit? And I think it's very questionable.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.